Good morning, everyone. Good afternoon and good evening. Thank you for joining us today. My name is Michelle Rodriguez, and I'm thrilled to be your moderator for this webinar hosted by UPS Supply Chain Solutions. We have a really exciting session lined up for you, packed with some great insights to help you navigate 2026. Before we begin, I have a few admin updates to share. This meeting is being recorded and the recording will be made available to all of you after the event. We do highly encourage participation and we want to answer all of your questions. So please make sure to use of the Q&A function in the webinar. We advise not using the chat feature to submit your questions, but please do use the Q&A function. Our panelists will be answering your Q&As at the end of the call. And then lastly, as we finish the webinar, please be on the lookout for our webinar survey pop-up. This will help us improve our future webinars, and we greatly appreciate all of your feedback. And now, for legal purposes, I will read the following statement verbatim. At the date of this publication, policies are evolving. This presentation is for informational purposes only. It does not constitute legal advice. Please consult with your own legal counsel for such advice. Do not rely on this information without performing your own research. And with that, please join me in welcoming our panel of speakers who bring a wealth of experience and insights to today's discussion. As mentioned, my name is Michelle Rodriguez. I'm a marketing manager for UPS Supply Chain Solutions. And with me today, we have Joseph Green, our Global Business Planning Manager. We also have our vice presidents from our global air and ocean products, Vito Losurdo and Steve McMichael. We have Stephen Cronenthal, our managing director for UPS Global Logistics and Distribution. And lastly, Catherine Mellar, Global Public Affairs Vice President. So let's take a look at today's agenda. We're going to cover a few things. And first, we'll start off with the latest developments in the air and ocean freight markets. We'll move into today's automation role in transforming warehouse operations and how that enhances the customer experience. We're going to provide an update on upcoming tariff actions and what implications that may bring for you. And then lastly, we'll cover any strategies or UPS solutions that can help you as you move into 2026. So with that, I'll hand it over to Joe, who's going to give you a snapshot on some macro signals that are shaping 2026 supply chains.
Hey everyone. So today I'm going to be walking through the 2026 global economic outlook with a focus on GDP and GDP growth and export dynamics. So the headline for next year is going to be that 2026 should be a year of stable but uneven growth, with exports under pressure in several major economies, even as domestic demand supports GDP growth. So we'll start with the United States. According to our base case, the U.S. economy is not headed into a recession in 2026. Instead, we're expecting GDP growth at roughly its potential rate, supported by several key tailwinds. So the biggest supports are going to be fiscal stimulus, including personal tax cuts, elevated refunds, and rising federal spending on defense and border security. We're also going to see a boost from inventory rebuilding and tariff-driven import costs, which shift some demand back towards domestic producers. Now, exports, here the story is more complicated. So tariffs raise costs for imported goods, which helps domestic output, but they also provoke retaliatory measures abroad. So combined with a strong dollar through 2025 and still elevated policy uncertainty, U.S. export growth is likely to remain subdued, meaning that GDP is going to heavily rely on domestic demand rather than trade. So Western Europe, uh, the outlook's a little more mixed. So domestic demand is improving thanks to strong labor markets, lower inflation, and more accommodative monetary policy. But exports are going to be a clear weak spot. There's going to be negative contributions from trade across most of Western Europe, driven by stronger European currencies, which are going to hurt competitiveness. higher US tariffs on European exports, and a structural loss of market share in China and other third markets. So the net effect is going to be, even with better domestic demand, Europe's GDP growth is expected to be slightly below 2025 levels, with exports acting as a drag. Um, as far as China goes, China had a pretty strong performance in 2025. Um, Backfilling US demand for Chinese goods was a little easier than we anticipated. But that momentum is expected to fade in 2026. So there are three forces shaping the Chinese export outlook. So the first is elevated uncertainties, including shifting global demand. The second is still elevated US tariffs, although they're expected to be lower than in 2025. And China's growing share of exports to emerging economies, which should provide some cushion. Um, GDP growth will slow slightly as the export engine weakens, but stimulus measures, including pro-consumption subsidies and targeted investment, are going to support domestic demand. So net exports, however, are not going to play the same role they did in 2025, which is why you see this sharp slowdown. Um, in India, India will remain the world's fastest growing major economy in 2026, but even here, exports are going to create friction. So high tariffs on U.S. tariffs on Indian goods are going to mean that net exports are going to be a drag on GDP growth, contributing to a slight moderation from 2025's pace. Service exports will remain strong, but goods exports are going to face headwinds. Domestic demand, supported by monetary easing and resilient consumption, are going to keep GDP growth strong. But like the US and Europe, India's growth story is domestically driven, not export led. Um, so, tw so 2026 is going to be a year of divergence between emerging markets and developing economies. So large emerging markets, especially in Asia Pacific, are going to see export growth slow sharply, driven by an unwinding of tariff front loading from 2025, softer global demand, and tariff exposure due to integration into global supply chains. So stepping back, the big picture is that across the major economies, trade is no longer going to be a primary driver of GDP growth. Instead, the US is going to be relying on fiscal policy and domestic production. Europe's going to face structural challenges, and China is going to see export momentum cooling. Um, so just if you take one thing away from this presentation, it should be this. GDP growth in 2026 is going to be stable, but its composition is shifting away from trade. So thank you. I'll go ahead and pass it over to Vito, but I'd be happy to take any questions through the Q&A function.
So welcome to all the participants. I had a little delay in turning on my video, so apologies for that. On this first slide here, I'm going to cover the global air freight outlook for 2026. So in 2026, moderate growth is expected in the global air freight market, driven largely by continued e-commerce development. So in this first section, we're going to take a look at demand drivers. Overall demand growth is expected to be muted compared to 2025, with an expected increase of about 2.7% globally. APAC exports and intra-APAC trade are leading the way, growing by 3.2% and 3.5% respectively. The US outbound market is also strong, with a 2.2% increase primarily on the US to Europe lane. So you can expect capacity to shift to intra-Asia and Asia to Europe in 2026. We're also seeing a realignment of dominant global trade lanes. For example, volume is shifting toward the Silk Road from traditional trans-Pacific routes. High-tech sectors, particularly AI-related infrastructure and e-commerce verticals, will continue to drive demand despite regulatory changes impacting our e-commerce globally. In this next section, we'll take a look at capacity and rate trends. Overcapacity is a key theme as demand is expected to be lower than available capacity. This will put downward pressure on rates, making them highly trade lane dependent. As an example, Southeast Asia will likely stay elevated, and China to US could see downward pressure. Freighter demand remains high with utilization at record levels, and networks are reallocating capacity to high growth, high yield segments. I mentioned Asia to Europe and intra-Asia earlier, but also Southeast Asia will likely continue to draw on available capacity previously serving other markets. So another challenge that we could face is that freighter deliveries continue to remain behind schedule. In this next section, disruptions and impacts to monitor. Regulatory changes, tariff updates, and global trade negotiation will continue to drive volatility, creating uncertainty in rates and capacity. Supply chain costs are rising, adding uncertainty to global trade. Sustainability and emissions initiatives remain a priority alongside moderate macroeconomic outlooks. So in summary, while overall growth remains moderate, the shift in volumes from Asia toward Europe could constrain capacity on Asia to the Americas routes. Success in 2026 will hinge on proactive monitoring of available capacity, regulatory developments, and sustainability initiatives. So if we can shift to the next slide, and on this slide, I'll cover the North American air freight outlook in 2026. So today on this slide, we'll discuss the key trends shaping the North American air freight market for 2026, and the overarching theme that is clear is that supply chain resilience will be a must-have to compete effectively. So in the first section, looking at supply chain trends, decision makers expect tariffs to remain volatile through 2026, which means uncertainty will continue to influence trade strategies. Businesses are adopting the US Plus One strategy, introducing a new era of trade diversification beyond the US. Mexico is emerging as the strongest nearshoring leader, driven by foreign direct investment and improved access to the US market. And from a growth and capacity perspective, S&P Global Market Intelligence forecasts 2.3% growth in the US for 2026. Truckload and less than truckload freight markets are showing early but tentative signs of rebalancing as fleet capacity begins to contract. TD Cowen and AFS Freight Index predicts LTL carriers will continue implementing cost-effective strategies and optimizing networks to endure a soft market. So in 2026, we should expect further consolidation in the ground segment. So disruptions we should monitor. Foreign direct investment surged 137% over Q1, reaching $102 billion, largely due to negotiations by the current administration. Inflation hinges on the Supreme Court's upcoming upruling of the IEEPA tariffs. U.S. tariffs on heavy-duty trucks, steel, and aluminum remain a critical factor. Businesses should view 2026 as a pivotal year to embrace supply chain flexibility. In summary, 2026 will be a year of strategic adaptation. Companies that prioritize resilience and flexibility will gain a competitive advantage in navigating tariff volatility, capacity shifts, and global trade realignments. And similar to what Joe reminded all of you earlier, is we are encouraging questions in the Q&A. So please submit any questions you would have for me. So with this, I'll turn it over to Steve McMichael.
Thank you, Vito, and good day, everybody. Let's take a minute or two to just talk about the choppy waters of 2025. You know, the stop and go of tariff uncertainty definitely kept the ocean carriers in another volatile situation, managing capacity with the yo-yo of the spot market. You know, we continue to be challenged as an industry to manage rate volatility and service There will continue to be rate wars between the carriers and the forwarders. Service, visibility, value solutions continues to be our focus here at UPS, but fully understanding that competitive pricing, rate maintenance, and invoicing is still important to our customers. So what's the outlook for 26? And what are the global market trends that we're really zoning in on? First and foremost is ocean carrier, financial instability, number one. No doubt the carrier financials are shifting. 2024, the ocean carriers had a 60 billion profit. We expect numbers to be significantly less than that, but still showing a $20 billion profit in 25 based on our sources, in this case, Drury. But there's a forecasted loss of 10 billion in 2026. So with the rate pressures this year, capacity not being filled, you can understand that the carrier panic in 26 is going to be real. That likely means more blank sailings, more capacity control, reduced schedule reliability, and the continuous rate volatility. Of course, this is going to lead to some difficult contract negotiations that we all go through. Those will start heating up in Q1, certainly for the Asia to US trade. Carriers are going to have some difficult decisions to make, how they play the game with the BCOs, direct carrier contracts versus us as an NVOCC market. And obviously as they manage that through their fixed rate capacity. As we look at demand, I'm going to share some pretty staggering statistics with you for a minute. In 2020, global ocean capacity was at 23.6 million TEUs. In just the last 3 years, we've seen an increase in 23 of 8%, 11% increase in 24, and a 6.9% capacity increase in 25. The vessel order book is already out there for an additional 10 million in TEUs. That's a 30% increase of the active fleet. By 2029, global capacity is forecast to exceed 40 million TEUs. Needless to say, carriers were making money. They were investing. New ships, sustainable, fleet-efficient ships, but grabbing market share and filling up vessels and making money in the foreseeable future is going to be difficult. As the carriers control capacity, they'll continue to look at the Cape of Good Hope. We'll spend a little bit more time talking about that in a minute, but that reduced about 9% of the capacity based on those routing excursions. And clearly, there were months of front loading that led to a significant U.S. import slowdown. We have already got a final forecast of December at a negative 17.9%. The outlook into first quarter, 11% volume decline in January, a 9% decline in February, and a 16% decline in March. So if you tie all that together, more chaos, more rate negotiations, more volatility. As we look at disruption and impacts to monitor, recently CMA did start testing the first alliance service through the Suez Canal in 2 years. That included a backhaul leg to Asia. Maersk and other carriers are beginning to analyze a return. And while positive news, CMA and other carriers have stated that it's unlikely that we'll see a rapid return to the Suez Canal transits and mainland services. Longer term security will certainly be required as they look at that level of complexity. One thing for sure, congestion and berthing delays impacted global trade throughout 25, particularly in the Northern Europe terminals. Labor shortages, additional port calls via alliance changes, Red Sea avoidance, Rhine River water levels, and weather are driving persistent strain on port and terminal operations. And as Vito alluded to, as well as Joe, we will continue to see sourcing shift. Ocean carriers will continue to evaluate their schedules along with the forecast of all of us and how they're going to support the shift from China to Southeast Asia. And certainly we see more trade increasing in Asia, Europe. CFS locations, local transportation, even vendor disciplines are things that are certainly causing disruptions today. Depends on good partners, good communication on your forecast and your sourcing moving into that area of the world. So as I say often to my UPS Ocean team and our customers, let's stay buckled up. It's going to be another fun ride in 26. The industry has certainly tested us to be resilient. I would just encourage open lines of communication with your account teams, constructive discussions around rates and service, and just continuing to be resilient, be flexible with multimodal mode shift options. That's where we're here to help service you. So from the UPS team, thanks for participating today, and look forward to your questions a little bit later. I think I'll turn it over to Mr. Stephen Crothenthal now from our global distribution team.
Thank you very much, Steve. Well, I get the privilege to really talk to a lot of the automation and some of the digital transformation that we're seeing across the industry. And, as we look kind of leading into 2026, we've seen a lot of focus and a lot of attention on investing in technologies, whether it's robotics, whether it's digital platforms, all the things that are needed to help us do more with information that we're gathering and capturing across the supply chain. And so as we look into 2026, logistics companies are really expected to be investing heavily in AI, robotics, warehouse automation, as these technologies are really shifting from a nice to have to really an operational necessity to support the needs of the day-to-day activity. AI is really driving a lot of the predictive analytics, some of that demand forecasting, and some of the autonomous decision making that in days past were being done by people and algorithms that we're creating ourselves. But with this activity coming in, we're enabling an increase in efficiency of somewhere near 30% and some of the cost reductions of about 15% across the supply chains. Robotics, particularly AI-powered and autonomous mobile robots, will dominate the intralogistics operations. We're seeing these in our operations, improving some of our pick accuracy, enabling us to increase our throughput, and really important is enabling us to scale our operations as we need to support the needs of the up and down seasonal volume from our customers, while reducing a lot of the reliance on labor to be able to come in and quickly pick up and understand what's needed to get the jobs done. Warehouse operations today are becoming more software-defined ecosystems. We're integrating AI-enabled vision systems. We have orchestration platforms. We're actually working with our providers to offer that offer robotics as a service. And these models are really broadening access to automation and minimizing the upfront capital investments that it takes to bring these technologies into the day-to-day activity. These trends are reflecting a broader push towards more flexible, data-driven, and sustainable logistics networks, with generative AI and digital twins emerging as critical tools for real-time visibility and decision-making. And as we look beyond just the warehouse, we also are seeing similar investments across the supply chain that relate to global freight forwarding and brokerage, as Steve and Vito and Joe spoke about, just kind of making sure that we're leveraging technology to help us make real-time decisions and make critical moves as we move across the entire supply chain. So with that, shifting on as we really understand some of the challenges in talking to our customers, really having visibility across the entire supply chain is really a very important thing. If we move on to the next slide there, you will kind of showcase a lot of what our customers have said and we're seeing as we engage is 90% of our customers executives say visibility is vital to the success of their organization. But what's odd is less than 1/3 of them have actually achieved it. They also report that poor visibility tends to lead to 50% higher inventory carrying costs, 30% longer lead times, and sometimes even 15% higher rate of customer complaints. With those challenges and those problems, it's definitely something that needs to be solved. But obviously, improving those challenges is not so simple as we look across a complex supply chain. As you may know, this information might be found in multiple systems that aren't connected. It's hard to put all the pieces together. We're employing resources to mine data and put it together in the views that are needed to help understand how things are happening across the supply chain. And in order to do that, you've got to compensate for some of that slow manual process that may be costly and could be inaccurate with labor going through it. Back up to the other slide. With that, obviously that's negatively impacting the business, but obviously with the right tools in place, we can overcome those problems. And UPS certainly understands those challenges, and we are committed to solving those by continually investing in the technologies that enhance our customers' ability to manage the supply chain and being able to focus on what you do best, and that's running the business. And with that, we shift on to the next one now, and really like to introduce the tool that we've pulled into the supply chain here, which is what we call UPS Supply Chain Symphony. And so this is our platform that we use that provides visibility across the entire supply chain of the many different services that are leveraged to be able to monitor and manage and communicate on activity as it's traveling through the supply chain. With UPS Supply Chain Symphony, we do address the visibility challenge and we deliver a global solution. With the integration to our data warehouses, which are housing information from the many different systems that we have across our global supply chain, UPS Supply Chain Solutions provides that near real-time consolidated visibility platform to view and monitor all the global supply chain activities. Now, the answers to questions are addressed when they're asked. Reports can be created with the click of a button, and the complexity of the global supply chain has been simplified. And with that, now we have a tool that can pull all the information together and leverage APIs with our customers' connections to be able to help bring that visibility requirement that executives are expecting into the table, into the boardroom, to be able to make decisions as needed versus relying on the more complex manual-driven reporting that's being done today. So with that, I do appreciate the opportunity of everybody attending and the opportunity to share this information, and I'll now turn it over to Catherine.
Thank you, Stephen, and good morning, everyone. As we close out this year, I'll walk through my slide to review the latest trade developments and what remains on the agenda for this year, speculate a little bit on what we can reasonably expect for 2026. This year has certainly made trade experts out of all of us, and I'll use some shorthand that you'll recognize, i.e. emergency tariffs, fentanyl tariffs, Russian oil measures, etc. So we're ending the year around an effective average tariff rate for US imports across all markets at 16.5%, which obviously is well up from where we were this time last year, where that rate was at 2.5%. But it is slightly lower than where we were a couple of months ago, which was close to 18%, where we had some period of greater escalation. From a general policy sense, we're leveling off into a period of what we would describe as some cautious predictability in tariffs, a medium-term assurance that the rates that we're looking at today, with a few exceptions, are sticking around. Driving this predictability for 2026 will be mostly the 18 completed bilateral trade deals that the White House has achieved in the last several months. This includes a deal with the European Union, with the UK, with Japan, and covers approximately 40% of imports coming into the US at the moment. These agreements, and we've listed some here on the slide, have not gone through Congress like they traditionally did in the past, but they are backed by joint statements between both governments, and they'll likely survive the current legal challenge, which I'll talk about in a minute. The average rate is 15%. And the three major outliers to these deals and these deal structures are China, India, and USMCA. So starting with China, the current average tariff rate is 47% on imports, and that's a combination of the average Section 301 tariff plus the 10% IEEPA reciprocal plus the 10% IEEPA fentanyl tariff. And that's a new rate that was agreed to on October 30 by the leaders, and it is lower than it has been since May of this year when the fentanyl tariff rate was at 20%, and it's certainly lower than when we peaked earlier this year at 127% on imports from China. With the caveat that the US-China relationship is always subject to change, there is a high degree of political commitment to keeping these rates steady for the next year. There is a joint statement, there is an obligation for the two leaders to meet again, and this 47% tariff rate looks more stable than we had seen earlier this year. On India, the rate is 50%, 25 reciprocal, 25 Russian oil. The US government has a steady cadence of meetings with India. They have said publicly that we should expect an announcement on a deal with India early in the new year. And we have every expectation that that announcement will include a lowering of the tariff rate with India. On USMCA, we have it listed here both in the green circle, which indicates a confirmed trade agreement, but also a yellow ring. And that's because while the USMCA agreement is the only pre-2025 trade agreement that is still in force, it's our only trade lane that's tariff-free at the moment. The agreement itself is going through an official period of review, a consultation between the three governments, a consultation between business and the three governments. So 2026 for the USMCA agreement is a watch this space piece of policy. Moving now to the sector-specific tariffs, the Section 232s. The government has 6 sector-specific tariffs in place. Most notably, I'm sure you're all aware, is the steel and aluminum derivative tariff. But there are still 10 pending investigations, and some of the categories being reviewed by the Department of Commerce include some widely applicable categories like semiconductors, pharmaceuticals, and robotics. In terms of what is ahead, the process is fairly opaque, but I would note that applying a tariff rate at the conclusion of these investigations is only one of the actions that the government can take. They can choose other trade remedies, they can delay the implementation of the tariff, or they can tie the trade remedy to other policies, which we have seen them do recently with the pharmaceutical 232. So the bottom line when looking ahead for the sector-specific tariffs is that we have little predictability on the timing and or rate in 2026, but not all of them are confirmed to come with a new tariff burden. And this brings me to the slightly more positive topic of exemptions and what we could expect next year. As of today, the exemptions are listed in Annex 2 and Annex 3 of the Reciprocal Trade Agreement Act, which is found on the White House and USTR website. There was a significant expansion of the goods included on this list on November 14th this year, and they were mostly agriculture goods. But the justification for the expansion was that the US had no domestic source for those goods. They said the government has said that they are continuing to review that standard of availability, and that this list could be further amended to include other essential goods not made in the US that would qualify for a tariff-free exemption. Before I turn to the IEEPA case, I'll just add that UPS is involved in advocacy in Washington which is where I'm based in our DC office, our priority is that these changes that are being made in this fairly volatile tariff environment, that importers have maximum transparency and predictability in order to support your business planning and your compliance. We know how difficult this environment has been for some of our customers, particularly the rules as it relates to derivatives. And we're engaging the right decision makers here in DC with information on how that is impacting business in America and what some ideas for simplification might be. And this brings me to the last point, which is the Supreme Court legal case against Trump's use of emergency tariffs. And this is a big question mark for 2026. And this webinar is not designed to walk you through the how-to in preparation for what might happen. But I will give a couple of data points and then a couple of suggestions for following up with your UPS support team. Firstly, as folks know, the case began at the Supreme Court on November 5th with oral arguments. We should expect a decision between now and mid next year. June is the latest that we would hear a ruling from the court. And has been well speculated publicly. There are several possible outcomes. The court could uphold the tariffs, creating a business as usual environment for us all. They could strike down the tariffs and invalidate the previously collected duties, or they could strike down partially some of the tariffs and or rule that only future collection of IEEPA tariffs is illegal, meaning current collected tariffs are not required a refund. In the second scenario, if the tariffs are struck down, legal experts have said that publicly that businesses should expect a refund. That will be very dependent on the specifics of each import. And our advice to you is that if you have questions on how this will impact your business, how you should plan to be ready, should that be the outcome of the court, that we ask you talk to your UPS customer support team and they can work with you individually based on what your needs are. From a go-forward perspective, if the IEEPA tariffs are struck down, we would expect the government to immediately reissue tariffs under a different authority in the Trade Act. There are many available rules that could allow for executive implementation of tariff rates that are similar to the rates we are currently seeing, up to 15%. We'd also expect Congress to seek legislative action to backfill the tariff rates and give them more durability beyond the tools of the executive of the White House. All that to say that should the IEEPA case be ruled against, we would expect the tariff environment to continue as it is into the future, particularly with the 18 agreements that have already been signed. And that is my presentation. I'll turn it back to Michelle.
Thank you, Catherine, and thank you to all of our presenters for sharing such great content this far. Before we head into our Q&A, I do want to highlight a few of our capabilities that can potentially help you navigate as we head into 2026. This slide that you see right here can give you a quick snapshot of UPS's logistics solutions that are built to keep your businesses running and ready for change that we're expecting in 2026. So on the air, ocean, and ground freight side, we have flexible multimodal options all the way from next day air to deferred ground, plus full container load and less than container load ocean freight that can help you balance speed, cost, and reliability across global trade lanes. On the warehousing and distribution front, we offer complete end-to-end support, including storage, pick, pack, and ship, and robust value-added services so that you can scale efficiently when and where you need to. On the customs brokerage side, we've been in this business for over 100 years, and we help customers streamline their documentation and their export filings to keep their shipments moving and efficiently crossing borders. And lastly, On the healthcare complex shipping side, we offer specialized solutions for temperature sensitive and urgent shipments, including cold chain and next flight out services. These solutions are just a small snapshot of what we offer. They're designed to help you give you flexibility, control, and confidence as you adapt for what's to come in 2026. With that, I will move into the Q&A portion of the webinar. We've received tons of questions from our audience, so we're really excited to address those here, and our panel of experts are here to answer those. So the first question, and many of the questions that have come in are for Catherine, so I'll start with her. The first question we'll say is, with customs regulations changing so quickly, how can companies stay compliant without slowing down their operations?
Michelle, exactly. How to be consistent in an inconsistent environment. All I would say in response to that is that we are responding as a company in as close to real time as we can with advice on our website. And it is always prudent to review the changing environment, not just for how US import tariffs have changed, but how our partner countries for export have changed their tariffs. And at ups.com, if you click on the tab for latest tariff information, we update that regularly twice a week on what announcements have been made as a guide and a reference. Those updates includes links back to US government websites where we have assurance of confirmation that the rates have changed through the customs, through the CBP channels. So that would be my advice in staying current.
Great. Yeah, I saw some questions coming in on resources available to get the latest information. So thanks for sharing that. Let's go to the transportation side. So Vito, what steps can companies take now to stabilize their transportation costs despite market fluctuations?
Okay, thanks for the question. So there's a few things that companies can do. Number one is, planning. Pre-planning is very important in order to keep a steady supply chain. But there's options to contract with your provider long term. There are options to secure capacity and secure rates for a longer period of time. Typically, that allows for stability in rates and capacity. There's the opportunity to get ahead of your inventory, and that allows you to take a portion of your volume and maybe move it in a slower fashion. So you'll have, some of your demand that'll move maybe in an express or direct type environment, and then it creates an opportunity for some of the excess inventory that you've pre-planned for to slow it down a little and look at other modes of transportation, look at consolidated service from an air freight perspective. So that's some of the advice that I would give.
So Vito, can you talk to me a little bit about what are some of the biggest mistakes companies can make when they're responding to some of these disruptions?
Yeah, I think the lack of planning, kind of what I said earlier, right, where a company is in a more of a reactive type environment, and there's very little proactive measures being taken to maintain a steady supply chain. I think that in some organizations we see siloed decision making, where the procurement function may be disconnected from the business unit that really has to respond and ensure that they meet their customers' needs. So that's just a couple examples.
Yeah, Vito, I'll add on there too. I mean, you hit the nail on the head, and we had a great customer call yesterday where global procurement has their responsibility. We understand we have to have pricing elasticity, competitiveness. But when we get into implementation, when we start looking at service schedules on the ocean side, if we've quoted a single carrier at a on a lane and they blank sail, then there's limitations there. So it now requires us to start working with the logistics teams within your companies to find additional rates, additional capacity. So always being open on that front, I think, is important. But I would also say, sort of where Vito is going on the planning, what is the transit analysis that we can help you do? And how do you do that at a PO item SKU level as you're managing your inventory? We see it all the time. Buy the order at a 40-foot capacity level. If you're able to be flexible there and say, create mode shift, 20% maybe goes as express air freight, maybe a standard air freight mode. 30% maybe moves in our preferred LCL network. Move that product into the US and use our expedited NAF network that you heard Vito talking about. And then the balance of that order, do the consolidation. Let us optimize multiple orders in that container for you. Now you've got multiple channels moving a single PO, single item. Our services can help you do that. We can help you through that planning exercise. Just another recommendation there.
Great recommendation, Steve. Thanks for sharing. And while I have you, a question came in. So how are ocean carriers adjusting their networks in response to geopolitical tensions and port disruptions?
Yeah, it's, I would say post-pandemic, they are agile. I think the alliances are changing, as we know this year, but they have remained flexible. They will avoid all geopolitical situations. They will blank sail. They will skip ports of call, and they will do that with very limited notice. So that's where communication, visibility, using our system for that tracking, and of course, just staying on top of the market situation. But the carriers have created a lot of agility in how they're managing that across all the alliances now.
Great. Okay, let's move into the warehousing and distribution space a little bit. So, Stephen Cronenthal, how can small and mid-sized businesses leverage automation without this massive capital investment?
Hi, that is a great question, Michelle, and I appreciate the question and the opportunity to address it. So, one of the things that we've seen in our part of the organization is the ability to outsource and leverage the investments that UPS has made within our warehouses to be able to use a shared operation to be able to leverage that technology. Clearly, as you look maybe at your own warehouses and or growth, investing in that capital technology, the maintenance. I think there was a question on the maintenance on that side of it, maintaining it is a critical component and a cost that sometimes helps, causes it to go beyond where you want to be. What we've seen is by leveraging a lot of our multi-client operations and being able to leverage the investments and or just incrementally increasing the use of our automatic or robotics or some of the goods to person technologies that we're using enables us to bring a customer in, leverage shared environment, only pay for the activity or the space that they're using versus taking on a massive investment to be able to set up a facility to achieve the growth and then obviously work hard to get there. So, we work a lot with small to medium-sized customers to be able to incorporate them into our existing networks. And that's at the global level, whether it's a U.S. base, a European base, an APAC operation, we've got the abilities to support that and would welcome the opportunity to discuss further.
I'll see you in a minute.
Great. Thanks, Stephen. One more here for you. So it says, is there a need/demand that is not being fulfilled by the marketplace to support the implementation and ongoing maintenance and support of facility automation? I'm curious about where the gaps are in the marketplace based on your experience in the push for automation.
Yeah, and so what I would say to that is when we are working in the automation, we have many different partners that we work with, and then we're always evaluating new partners with some of the advancements in technologies. Many of those partners are also servicing the side of their robotics as a service, or the technology that they've deployed. So I would say in a quick summary, I feel like the support and the maintenance is there through the providers that we are working with. And then, just speaking directly on one of our operations that we have in Louisville, Kentucky, we have on-site staff that has been trained to be able to support the needs of the technology, to make sure that if something does, need addressing, it's brought up really quickly. But what I found is our partners and the relationships we have with those partners are really a nice bridge to ensuring that the equipment is always up and running, as well as, if a replacement item is needed, it's there quickly to ensure that we're not impacting service to our customers.
Wonderful. Okay, let's go back to you, Vito. I have a couple more questions for you here. So, first question, are there specific lanes or regions where you expect the most rate volatility this year or next year? Sorry.
Yeah, Michelle, I could think of probably a potential disruption like that and rate volatility in many lanes, because there's so many macroeconomic things that continue to get thrown at us. But I think that if I had to talk about some of the top where we could see some volatility, I think Southeast Asia to the world will continue to remain volatile. Couple reasons. There's manufacturing that is shifting out of other parts of the world, especially China, into Southeast Asia. Not only that is, runway availability is typically problematic in many of those countries. Although thankfully this year we'll have an additional runway out of Vietnam. But also the leisure travel that was pre-COVID, like going into countries like in and out of countries like Thailand and so on, it still hasn't come back fully. So that could be some rate volatility. I think, looking at the Americas, there could be rate volatility on the northern border. On the southern border, but northbound. So Mexico coming into the U.S. Related to some disruptions, some demand increases that we're seeing developing this year from Asia into Europe. That could create some rate volatility. And then I guess finally, the impact of capacity shifting from one area to another. So as an example, we've seen it a couple times this year where capacity has shifted from the Asia outbound trans-Pacific routes to Asia to Europe. So what that does is it creates a capacity situation on the trans-Pacific, right? And that allows carriers to increase the rates. So that's some of the areas where I think there could be problems.
Great. Thanks for sharing that insight. One more, Vito, here. How can shippers leverage consolidation to reduce air freight costs without sacrificing speed?
Yeah, I think one example is to take a look at your packaging. Many times when we look to optimize our consolidations, we look at some of our shippers and there's waste, right? There's waste in packaging where shipments are being sent in packaging that is too large for the contents. Taking a look at other opportunities where you could lighten your shipments related to the use of wooden skids versus cardboard skids, depending on the value of your product, plastic pallets, and so on. So I would say also talking to your providers about what specifically are the consolidation programs that we have. I could tell you that there is the ability to move freight slow or fast and still get the benefits of a consolidation because depending on the size of your provider, they may have a consolidated service that moves, for example, daily, going to some of the major destinations. So there's a lot of opportunity there, but it all starts with having a conversation, meeting with your provider, having whiteboard sessions, discussing, what are some ideas that both organizations have on how they can reduce costs.
Great. All right, thanks, Vito. So I think I have one more question here for Joe Green. We got a question that says, was asking for more specifics regarding GDP being held up by U.S. internal factors if it's not exports.
Yeah, so I've got some kind of bad news there because the government shutdown has kind of hampered our ability to really track what's going on in the data. So the most recent GDP forecast we have is still for the second quarter, right? So I will say, so consumer spending has held up pretty well. Not quite as strong as we've seen in recent years, but so consumer spending, particularly service spending, has been doing okay. As well as generally just like spending on AI has held up fairly strong. So that's one of the sectors that's been more or less exempt from a lot of the harsher tariffs. So so AI investment has been offsetting a lot of the sting from tariffs. So we do, even though we don't have third quarter GDP, we do have the Atlanta Fed produces a real-time tracking of GDP, and again, consumer spending has been held up pretty strong in the third quarter, as well as investment in equipment and intellectual property products. But yeah, overall, like I would say, just broadly, it's going to be consumer spending and AI investment.
Okay. Thanks, Joe. All right, so I think that was the last of the questions that we're able to answer today. I greatly appreciate all of our presenters' time today. Thank you to our audience for submitting such wonderful questions. We do have a log of all of the questions that have been submitted, so we'll do our best to respond to those as possible. And as mentioned at the start of the webinar, please keep an eye out to your email. This webinar recording will be sent out. Thanks so much, everyone, for the time, and have a great one.